Have you ever wondered about the challenges companies face when adopting NFRS for the first time? Welcome to our deep dive into NFRS 1, the first-time adoption of Nepal Financial Reporting Standards. This comprehensive standard, issued by the Nepal Accounting Standards Board, serves as a roadmap for entities making the switch from their previous accounting frameworks to comply with NFRS. Here's the thing. Transitioning to a new accounting standard isn't a walk in the park. It's akin to learning a new language, where you have to unlearn familiar patterns and adopt new ones. Companies often grapple with changes in accounting policies, recognition, measurement, and disclosure requirements. It's like trying to change the tires on a moving car. Complex, to say the least. But here's where NFRS 1 shines. This standard doesn't just tell you where to go, it gives you a structured approach to get there. It's like a GPS for your financial reporting transition, guiding you around potential roadblocks and ensuring a smoother journey to NFRS compliance. So what are these roadblocks? Well, first and foremost, there's the challenge of policy changes. Each company has its own unique set of accounting policies, and aligning these with NFRS can be a mammoth task. Then there's the issue of recognition and measurement. NFRS has its own specific rules for recognizing and measuring financial events, which may differ significantly from a company's previous methods. And let's not forget about disclosure requirements. Under NFRS, companies may need to disclose more information than they're used to, adding another layer of complexity to the transition. Despite these challenges, the adoption of NFRS 1 is not a hurdle, but an opportunity. It allows companies to align with international best practices, enhancing their credibility and opening doors to global markets. Now that we've looked at the challenges, let's delve into the objectives of NFRS 1. Through this lens, we can better understand the rationale behind the standard and how it aims to ensure high-quality, transparent, and comparable financial information. Buckle up, and let's continue our journey into the world of NFRS 1. So, what exactly are the objectives of NFRS 1? Well, let's dive right in. The primary aim of NFRS 1 is to ensure that an entity's first NFRS financial statements contain high-quality information. Now, what do we mean by high-quality information? There are 4 key elements to consider. Firstly, the information needs to be transparent for users. That means the financial statements should be clear, concise, and easy to understand, leaving no room for ambiguity. Secondly, the information should be comparable over all periods presented. This means that the data from different periods should be presented in a way that allows for easy comparison. It's crucial for users to be able to track changes and trends over time. The third objective is to provide a starting point for accounting under NFRS. This means that the first NFRS financial statements set the stage for all subsequent financial reporting under the new standards. It's like setting a baseline from which all future financial data can be measured. Finally, the information should be generated at a cost that does not exceed the benefit to users. In simpler terms, the cost of producing the financial statements should not outweigh the value that users get from them. It's all about achieving that balance between cost and benefit. With the objectives clear, let's move on to understand the scope of NFRS 1. The scope of NFRS 1 is quite specific. Let's explore it. When an entity decides to adopt Nepal Financial Reporting Standards, or NFRS, for the first time, NFRS 1 comes into play. It applies primarily to the first NFRS financial statements that an entity prepares and presents. This means it covers the initial financial statements that demonstrate an entity's shift from its previous accounting framework to NFRS. But it doesn't stop there. NFRS 1 also applies to any interim financial statements that an entity presents under NAS 34, or interim financial reporting, for any part of the period that is covered by the first NFRS financial statements. This means that even if an entity is in the middle of a financial period when it decides to adopt NFRS, NFRS 1 will provide the guidance necessary to prepare and present those interim financial statements. Understanding the scope is crucial, but so is knowing the stages of transition. Transitioning to NFRS is a process. Let's talk about the stages involved. The journey begins with the selection of accounting policies. These policies must comply with NFRS guidelines and remain consistent across all periods presented, including the opening NFRS statement of financial position. It's important to remember that different versions effective at earlier dates must not be applied. However, if a new NFRS permits early application, a first-time adopter has the option to adopt that standard early, but it is not absolutely necessary to do so. The next stop on our journey is the preparation and presentation of an opening NFRS statement of financial position, which serves as the starting point for accounting under NFRS. This statement is essentially a snapshot of the company's financial position at the date of transition, which sets the stage for all future financial accounting under NFRS. Now let's move on to estimates. In accordance with NFRS, estimates must be made for the opening statement of financial position and all other periods covered by the financial statements. Here's something crucial to remember. If information is received after the date of transition that is relevant to estimates made under previous GDAP, it should be treated as for non-adjusting events according to NAS 10, which covers events after the reporting period. So, we've selected our policies, prepared our opening statement, and made our estimates. But the transition isn't over just yet. It's a journey, and like any journey, it requires time, effort, and a whole lot of patience. But with the guidance provided by NFRS 1, the process can be made a lot smoother and more manageable. And that's how a company transitions to NFRS. But what about exemptions? Well, we'll get to that in the next scene. Stay tuned. NFRS 1 does allow some exemptions. Let's see what they are. As we dive into the nitty-gritty of NFRS 1, it's worth noting that while the standard promotes full retrospective application on first-time adoption, there are limited exemptions in place. These exemptions are like a breath of fresh air amidst the complexity of a transition. They serve as options that first-time adopters can elect to use, making the process slightly less daunting. One of these exemptions is deemed cost. This allows entities to measure some or all of their assets and liabilities at amounts other than their previous GAAP amounts. A handy tool when the cost of retrospective application outweighs the benefits. Next up is business combinations. Now this is an interesting one. NFRS 1 allows an exemption from restating business combinations that occurred before the date of transition to NFRS. It gives entities an option to keep those past business combinations as they were, neatly tucked away in the financial history. Exemptions also extend to leases, borrowing costs, and even cumulative translation differences. These areas can be complex, and the exemptions provide some flexibility in dealing with them. There are other exemptions too, such as compound financial instruments, assets and liabilities of subsidiaries, associates, and joint ventures, and share-based payment transactions, to name a few. Remember though, while these exemptions can lighten the load, they must be chosen thoughtfully, keeping in mind the ultimate goal: high quality, transparent, and comparable financial information. Exemptions can be a relief, but they must be used wisely. Let's now focus on the comparative information required. Comparative information is a key aspect of financial reporting under NFRS. Let's find out why. When we speak of comparative information, we're referring to the requirement under NAS 1, the presentation of financial statements, which mandates that the first NFRS financial statements must include a comprehensive set of documents. This set includes 3 statements of financial position, 2 statements of profit or loss, and other comprehensive income, 2 statements of cash flows, 2 statements of changes in equity and related notes, including comparative information. But what's the rationale behind this requirement? Why do we need comparative information in the first place? The answer lies in the twin pillars of financial reporting: transparency and comparability. By presenting comparative information, entities can provide a clear picture of their financial performance and position over time. This allows stakeholders such as investors, lenders, and regulators to make informed decisions based on a thorough understanding of the entity's financial trajectory. Think of it this way: without comparative information, we would be looking at a snapshot of an entity's financial position at a single point in time. While this might provide some insights, it wouldn't give us the full story. It's akin to trying to understand a movie by watching a single scene. You might get a sense of what's happening in that moment, but you'd miss out on the broader narrative. Comparative information provides the necessary context to understand an entity's financial journey. By comparing financial statements across different periods, we can identify trends, evaluate performance, and make meaningful comparisons. Essentially, it's like watching the entire movie instead of a single scene, providing a more complete and accurate understanding of the entity's financial story. However, compiling this comparative information isn't just a matter of duplicating previous financial statements. Entities must ensure that their financial statements comply with NFRS, both for the current period and each comparative period presented. This ensures that the financial information is consistent, reliable, and truly comparable. And that wraps up our discussion on NFRS 1 and its role in the transition to NFRS. Remember, understanding is the first step to successful implementation.